Good morning and welcome to the first in the room of 2023. Good to be back, and today we're actually in Peregrine Capital offices in Sandton, Joburg, and I'm joined by Jacques Conradi. Welcome Jacques.
Thanks, Steve.
Jacques is the CEO and a portfolio manager at Peregrine Capital. So from my side, it's nice to be in Joburg. Normally I have to travel down to the Cape, where most of the asset managers are based, so it's quite nice to have one at home for a change. Before we get going, I'm just going to run through some house rules. So today's theme is obviously we're talking about hedge funds, and we really want to get into kind of the nitty-gritty about hedge funds, particularly from a retail investor point of view. I think they are quite topical, so I'm looking forward to the conversation. Couple of the house rules. As always, the webinar is an hour long. We will stick to the time. I'm quite pedantic about it. Jacques and I will chat for about 20-25 minutes, and then we'll open the floor to some questions. Please type the questions in the Q&A, and then my colleague Arifa will moderate them for me and put them on the screen. I'm Steve Backhouse. I often forget to introduce myself, part of the Innate team. And one other thing, just CPD points. We always get asked about CPD points. You'll probably get one CPD point for today's webinar. Fortunately, we only actually ever know these things now post the sessions. Importantly, you do need to stay for the full hour of the webinar to get automatically allocated the CPD point. But if you aren't able to, you are able to watch a recording, and then you can do a short assessment, which then allows you to get the CPD point. Cool. So I think that's it for the formalities, and we can get into the conversation. So again, welcome again, Jacques. Lucky to be here.
Thanks, Steve. Thanks for having me on. Nice to be here.
Yeah. So I mean, first of all, to start off, I always like to ask kind of a personal type of questions. And like, how did you get into kind of the hedge fund investment industry?
Yeah, so let me take you back, and I'll give you some of the history around it. If I look back at school, I always loved maths and computer science, and because of that, I went to study actuarial science at Stellenbosch. And coincidentally, what got me into the markets for the first time was a stock exchange game we had at the end of my first year. I think we were a few thousand of the first years that played this. So it's paper money, it's not real money. Yeah. There was some prize money. I think it was 2,000 Rand prize money, which is like 4 months.
It's a lot of money in those
days. It's like 4 months pocket money, right? So that's like quite a few nights out and quite a few events you can go to. So like, I really want to have a go at this thing. So for the first month of the competition, I built like a nice diversified portfolio. I think I was up like 5 or 7%, but I was only like in the top 200 of the 2,000. And I'm like sitting there and thinking, this is a paper portfolio. There's no point being in the top 100. Like, I got to go for the prize money. So what do? You say, okay, I'm going to put everything in one share. And what I do, I put everything in a small cap share, because small cap shares are more volatile. So it gives me a chance of the thing going up 100 or 200%. So I picked the small cap that was going to have results in the next few weeks, put the whole fund in there. And fortunately, the results was good. And I think the thing went up 50 or 100%. And I won the game, which is a bit of the opposite of what we do now, right?
You probably should be disqualified, actually. I mean, it's kind of, that probably wasn't what they were trying to achieve.
Yes, but it was within the rules of the game, and you got to play within the rules to win, and that's what I did. And unfortunately, that ended up going well. So as you said, it's a bit of the opposite of how we run portfolios now. But that really got me into markets, and I then went to my dad and said, "Look, I won the stock exchange competition. Never mind that it was in one share. Let's start a portfolio." So he gave me some of his money, and I had a little bit of money saved up from maths and computer programming Olympiads that I put in, and started trading that. And basically did that during my university years. I then still went to a mutual, qualified as an actuary, and I stayed there for about 18 months. So, I mean, one of my personality aspects is I'm fairly restless, and I get bored very easily. And I think after 18 months at Old Mutual, I was like, this is not stimulating enough. There must be something more out there that's going to keep me interested and keep me learning. And then I think I'd obviously been investing in markets, and I loved that, and started looking around in SA. And then fortunately spoke to someone that knew people at Peregrine Capital, ended up coming here. Obviously, we were a smaller and different business back in the day. Joined in 2007, so it's been 16 years. And one of the things in our business is our job is fairly simple. We need to make money for clients. And I think if someone joining here as an analyst, if you make consistent money for clients, you will do well here. And I think it's just been 16 years of that, doing that hopefully reasonably well.
So you said that you get restless quite easy, but you've been here 16 years.
Yes, well, and the reason is I think it's the best job in the world, or certainly the best job in the world for my personality type, because there's just new things happening in the market the whole time.
Yeah.
It's really an amazing job. We get to interact with kind of the CEOs of all top companies in SA. There's always sectors where there's something happening, or in the global economy. So it's hopefully the job that I can do for the rest of my life. I can't see myself getting bored in this business.
Yeah, and actually, I was just thinking, I got a pretty question I can ask you about that, but just now. But to get into the kind of the topic then of the conversation, so we're talking about hedge funds, and I think, as I said earlier, they're quite topical at the moment. I mean, there've been some movies about hedge funds. They were part of, I don't say the reason for the global financial crisis, but they were a big part of kind of when how it happened, and so there's some successes behind it. But now, what is the difference between, particularly in the SA market, between a hedge fund and your normal kind of traditional asset management portfolio?
So first, Steve, in many ways, it is the same. We also buy and sell shares in the market.
Yeah.
We try to find companies that will outperform, and we do make a lot of money just owning good companies that go up. So I think that's the similarities. There's obviously also collective investment schemes and available on the platforms, etc. The key differences then are the wider tool set that's available to hedge funds. And I think that's really the crux of what makes a difference. We've got more things that we can do to both generate returns and protect the downside. Obviously, the main thing is shorting, so betting against companies that we think will underperform. So when a share goes down, we've got the ability to make money off that, different to a long only. And through the use of derivatives, we've got ways to structure the payoffs on a company or a share to get a different payoff profile than a long only. And I think those two combined help you specifically protect the downside, but also generate additional returns.
So then, to maybe put it into practical, maybe a practical example might be quite useful, because so a lot of that's a bit of like theory, if you like.
Yes.
So maybe a practical example of a share or a couple of shares you've held, which then kind of gives the audience a good sense of how it might work.
Okay, I think that's a great idea. So, I mean, I just think off the top of my head, let's say it's obviously fresh in my head, a share we owned Tungela last year. It was our biggest.
So maybe also explain together.
Yes, okay, good idea. So it was probably one of the biggest winners we've had in the history of the fund. Maybe some context, it's the biggest coal mining business in SA. Anglo American spun it off to shareholders in June 2021. We at the time, in that first week of the spin-off, we'd done a lot of work beforehand. I don't want to give the full history here, but we typically want to be buyers when others are forced sellers, and we knew that for ESG reasons, a lot of foreigners and even some locals would just sell. If they got a coal company in their portfolio, they just need to clear that out. We like it when other people are forced sellers. That's typically when something's too cheap. So we bought about almost 5% of the company at that point in time. I think it was 25 Rand a share. It ended up being like 15 times money for us. So it was one of our best investments ever. But I think that the part I want to get to is how we structure the position. So firstly, we always want to manage downside, and every day we think probably more about that than a typical long only. How do we limit losses? So we had a certain risk appetite for the Tungela we're willing to own because of the volatility in the share. And obviously you don't know upfront exactly how it will play out. We thought there was big upside, but you can never be sure in markets, right? You're dealing with the future. So we had half our position in. When the Russia-Ukraine conflict happened in at the start of 2022, we saw
7-8 months later, basically.
Yes. Yeah. So we'd already done well in the share then, but we saw that this could be rocket fuel for the coal market, because Russia is a huge coal exporter, one of the biggest in the world to Europe. Because of the sanctions, that coal was not going to hit the market. So we thought this could be huge, but we already had our Tungela position size, and we thought, how can we get more Tungela but protect the downside? And we used two different hedge fund toolkits here. Firstly, we bought another few percent of Tungela and hedged that by going short actual coal in Europe. So basically, they sell coal. We know they sell coal. The coal price was $400 at the time.
Yeah.
So this is something you can't do in a long only fund. We shorted the actual coal contracts in Europe. It luckily doesn't require you to deliver physical shiploads of coal into Rotterdam. You can actually, it's just a financial contract.
Yeah.
But basically what you do is you lock in the coal price at that level. So two things, I mean, Tungela was like 150 a share, coal was 400. And our view was there was either the coal was going to halve, and we're going to make a ton of money on our short. But if the coal stayed at 400, even for 3 or 6 months, Tungela was just going to double.
Yeah.
You could just formulaically calculate how much they were going to make. So that was a beautiful trade where you were almost locking in 50 to 100% upside while capping the downside, because if coal falls, you're going to make more money on your hedge than you're going to lose on Tungela. So we did that. And what we also did is we found a bank that would write us put options on Tungela shares. We thought the puts were a bit mispriced for various somewhat more technical reasons, but we could get the puts very cheap. So what a put option does is you pay a small premium and someone else like a bank takes all the downside risk on a share. So that allowed us to buy a lot more Tungela, spend a small premium, so almost quantify, we can at most lose 5% on this. The bank takes all the additional downside, but we get all the upside. So combined those two transactions that a hedge fund can do, that probably doubled our P&L on our profit on Tungela last year by implementing that.
So am I right in saying you almost had 3 plays in Tungela, essentially?
Yes, yes.
Okay.
And obviously with hindsight now, if you knew the share was going to go up 3 times, you could have just bought more Tungela, but you never know that at the time, right? You think it might, but the world could change. Maybe they could settle, or they could do a ceasefire. So that's why you want to do more, but with the downside hedge.
But manage the risk on the downside.
Absolutely.
Okay, interesting, yeah. And then, I mean, at the same time, so obviously that's a good example of where it worked. I mean, what's an example where it didn't work, where you kind of you took a holding and actually you got hurt by it a bit?
So we do a lot of pair trades, and pair trades are typically where you go in the same sector, you go long one share and short another share, right? So last year we went long ShopRite because we loved what they were doing at 60-60 in Checkers. I could just see my wife's shopping had shifted entirely from Woolies to 60-60. So you knew Pick n Pay and Woolies was going to get hurt. So we went long ShopRite. We went short Pick n Pay and short Woolworths against that, because we thought they were going to take a lot of market share and it was going to come from Pick n Pay and Woolworths. So 2 things happened. The Pick n Pay leg worked very well. We made lots of money on ShopRite and made on Pick n Pay. But the Woolies short didn't work so well because Woolies ended up restructuring the Australian business. They ended up getting a seller for David Jones at quite a big price. The Australian business turned around. So the food business did underperform, but they had wins in the other part of the business. So on that leg, we lost. And I guess, I mean, we thought there was a risk, but they ended up probably getting a better price for Australia. And there was new management that probably also did a bit better in SA. So you're not always going to be perfect on these things, but that's basically the thesis. You see something in a company you like ShopRite that's taking share, and you bet on them, and you bet against the companies where the losses will come from, and you hope you get 7 or 8 out of 10 of those right.
I mean, the reality is, as we all know, like investing into the markets is not a perfect science.
Absolutely.
And again, it's impossible to get, well, it'd be nice to get 10 out of 10, but it doesn't happen often. Okay, so then one thing again we were chatting about earlier is actually is your view on the kind of the SA market, and you said now kind of at times you kind of can be quite contrarian to what others are doing. So what's your current view on the SA market, and where do you see opportunities in the SA market?
So look, it's certainly, I think, tough for a lot of South Africans. The last 6 months have been tough with all the load shedding we've seen. It's not kind of how we're supposed to live.
That might be how it is, though. Eh?
It might be how it is, right? So looking at this, we think South Africans are very resilient, and especially the SA corporate sector. We think the SA management teams of medium and large companies are exceptional, and they're world class. So companies are taking things in their own hands. I wish we had kind of companies known to do this earlier, but when we're talking to companies, everyone's making plans to put in solar, to put in purchase agreements. We know the DA in the Western Cape is doing that. So because of how bad things have gotten, the silver lining for me is both individuals and companies are taking aggressive action and installing renewables. It looks like the grid is being more open. It'll be easier to supply into the grid, and the private sector can react rapidly. They have done so in the past. So we actually think, and we track this. I think so far in the first quarter, up to the end of March, the amount of renewables that's gone into the system in SA is almost equivalent to the whole of last year. So it's like 4 times the run rate. We think that continues. So it rapidly will fill this hole that Eskom has left. So we think there's a reasonable chance that 18 to 24 months down the line, individuals and companies have taken things in their own hands and have supplied enough of their own power that this is no longer an issue. Now, people aren't seeing that at the moment. There's just big negative sentiment. I was at a conference recently with most of the SA asset managers and companies, and except for a few companies that spoke there, most of the asset managers and most of the companies were very bearish because of the electricity situation. But when everyone's bearish, it means the prices are low because it means everyone's selling and it means no one's buying. So when everyone's got almost a very certain negative view on something, it's often the right view to check on the other side of that, to say, can't I take the other side of this because this sentiment is so universally bearish? Look, you still have to be right on things turning. So if load shedding just gets worse and we're stuck at stage 8 still 2 years from now, then we're going to be wrong. But because of the work we've done, we don't think that's the case. So we've actually, in the last few months into this negative sentiment, deployed quite a lot of money in the SA market. I'm not as bearish as some. Look, I mean, there's always a chance our government does something else wrong, which typically they've done right. But specifically this electricity situation, we think gets resolved. And even Transnet, we think they're doing a lot of work to improve that right now.
But again, on your point, again, then you'll manage you'll put in some structures to also then manage that potential downside risk. Right.
Yeah,
Yeah.
correct. We,
Yeah.
we can
So
have put options to protect, and obviously
yeah.
we stay close to the things. If we see the renewables trajectory slowing down or anything else that
Yeah.
changes our thesis, we can change that. That's why, I mean, our asset base is much lower than the typical large long only. So we are nimble and we can change our
Yeah.
minds. But right now, that's based on the research we're doing and we're seeing. We think that's a good bet to take.
Yeah. So a couple of things as I was thinking while you're chatting there is about resilience, and South Africans are resilient in it. And I know this probably isn't right, but like, when the other day I was driving down my street, and for the guys who don't live in Joburg, unfortunately potholes have become a real issue, and I'm sure everyone knows that. But sure enough, there was a father and a son fixing the potholes in the street. Like, and I know it's not right, but that's resilience. Like,
Yeah.
that's taking it into your own hands. I think it's it's great. And the other thing I was thinking about in terms of is it kind of when things are not working, there's opportunities. I got an uncle who lives in Zimbabwe, and he says when there's chaos, there's money to be made. Eh?
Yeah.
And you think about what they've been through. It's an interesting, different mindset. It's a good, positive mindset.
Yes. Yeah. So look, I obviously hope we don't get there, but
No.
my view generally on living your life and running a business is you're not going to succeed if you're halfway there. If you're constantly, like a lot of people, like friends and stuff, they think, should I be in SA? Should I not? I'm committed to SA. Our business is committed. It's easier to live your life 100% committed to something. That's how you achieve something great. So we want to be part of the solution. We're going to do what we can to make this country better, and I think a lot of companies do take that view. So I'm somewhat optimistic.
Yeah. And your view on inflation? I mean, it's obviously it's above the kind of above the band at the moment. We just had a rate increase last week.
Yes.
Is inflation here to stay?
We think, especially globally, we think it's going to be tough to get inflation back down to 2%. And one of the big issues there is just the shortage of labor, shortage of staff. Like, we've pretty much got full employment in the US and the UK, most of Europe.
Yeah.
There's a shortage of people. And when inflation's 8 and there's not enough jobs to go around, you're going to have to give people 8% increases, right? Otherwise, they're going to just go somewhere else where they can get that. And once you start giving those high increases, that's in the past how inflation got embedded in SA, right? So we think it's going to be harder than they think to get inflation down. I mean, it's obviously come down from 9 or 10. It's not going to stay there, but we think it might hang around at 4 or 5%, which then means the Fed and ECB has to keep rates at kind of 5% for a longer period to try to manage that down.
And then from an SA perspective, are we takers of what happens globally then from inflation?
Yeah, precisely. Yeah. So it probably means that rates, we don't know if we need another rate hike, maybe just another 25 basis points after they did more than everyone thought last week.
Last week was 50 was a shock.
It certainly was.
The expectation was 25.
So I don't know if it's the right thing, but I like the fact that our Reserve Bank is so independent and they fiercely go after this inflation. It's one of the few SA departments that still function properly. So I'm not going to second guess them. They've done well to manage inflation under tricky circumstances for like 20 years now.
Yeah.
So I'll go with their judgment on this one. But I think it means we probably don't need much more. But I do think that rates probably have to stay there for some period of time in SA and globally.
Yeah. Just quickly, I mean, Narif is reminding me. It's please don't forget to type in your questions. This is your opportunity to ask Jacques direct questions. So please don't forget to do that, and we'll get to them just now. One thing again, going back to previous comments you made about kind of corporate SA. So obviously we've had some governance issues in corporate SA in the past. I mean, we've had Steinhoff, EOH, etc. I mean, do you think we passed those, or do you think there might be another risk of some of those coming through?
Look, it's often in those cases driven by a very small group of people, right? So it's probably not right to say that it'll never happen again. I think some percentage of people are crooks, and if they somehow rise to the top of companies, this could happen again. And there's also the greed driving it. I guess like, let's say someone like Marcus, he made a lot of money from this, and he's still I think living in his beach house in Hermanus, right? So he hasn't been put behind bars.
Spray paint on the wall. But
yes, unfortunately, the community doesn't like him, but he's still hanging around there. So I think we need to hopefully in time see the appropriate punishment there, and we probably need to see jail time and the like to almost deter people from doing this. I think the SA asset management industry overall has become somewhat more focused on this, given a few of those. Yes. So I think there's certainly a closer eye on governance. So I'd hope that we see less of that. And I guess in the past, many investors would say, if there's governance issues at a company, I just disinvest, sell my shares, move somewhere else. Where I think now that's probably somewhat changed to say, let me see if I can help fix this. Let me see if I can influence this. So I don't think it's that likely that it happens again, but it certainly is possible.
Yeah, I mean, of course, but do you feel it's kind of probably under control a bit more than it?
I'd say it is.
But also, surely, even with these guys kind of in the spotlight, that's going to make people scared. I mean, that's
for sure.
Yeah.
And look, as a hedge fund, one of our jobs is to try to find these and to try to be short these companies, right? And EOH, we were actually short. We made a lot of money on the short there. African Bank, which was a similar one, where we were actually short just till the end. So again, while I don't like to see it, it's part of our job. Firstly, avoiding owning those, and then using those as opportunities. And often by shorting them and getting the share to go down, it does get the news out there. And I think the EOH story only collapsed because the share price started going down. And that almost let the story out in the end.
Yeah. So I see some questions coming in, which is great. Thank you. Keep them coming. Reef is typing them up on the screen for me. Again, going back to kind of something you said earlier, so now you've been here 16 years. How is the kind of the investment universe and where you can allocate capital to? How's that changed over the last 16 years as a hedge fund manager?
So I think one has to assume that as time goes by, market steadily becomes more and more efficient. There's a lot of smart people at asset managers around SA and globally that participate in this market. So I think markets constantly trend towards more efficiency. So as a business, if you want to keep outperforming the market, which is certainly our goal, you have to keep getting better. So the key thing for me is almost year in, year out, we can never be a static business. We want to be a business that continues to learn from mistakes and use those lessons to refine our investment process to make sure at least we're not going to make that same mistake again. We're going to make some other mistake, but if you can limit the mistakes you make, that'll help. So there's been various cycles, Steve, where let's say when I joined, we made a lot of money out of SA small and mid-cap shares at that time. It was a bit of a small-cap boom, 2002, 2006 and 2007, which worked very well.
Stanley had a small-cap fund.
Yes, I remember.
And I was the Stanley, which I think one year we were performing at about 80%, and the following year I think we were minus 80%.
Yes, So that's the key thing. You got to look where the opportunities are, take advantage of them, but rotate out before the cycle changes. So that's why we've got a big team. We look at all the sectors, small, mid, and large, various sectors. Look at offshore. Look at high yield bonds. So we want to have a nice wide opportunity set and be able to say, there's opportunity there right now. Let's dig deep. Let's go there. But then if that opportunity is played out, we've made our money. Be able to sell back to cash. Don't fall in love with that. Go back to cash. Bank our profits, and then find the next opportunity. So I mean, I can't give you much specifics, but other than just saying, you have to keep getting better as a business, and you have to be able to rotate to different sectors. So since then, we added offshore as a key toolkit that probably wasn't that big back then. And then also added things like high yield bonds, especially offshore. So over time, I think we've evolved and grown as a business to also increase the playing field we can operate on. And
now you mentioned cash. I mean, any given, like, what's your biggest cash position you've ever held?
So
and I presume it's not from a you're actually holding it because you sold, not because it's actually taking a cash position.
Yes. So if I think of 2 times now, if I think back to COVID in 2020, what we did just before COVID happened, we put a lot of put options in place, like literally kind of days before markets started crashing. So the timing was very fortunate. I mean, we were literally in this boardroom. We're sitting now, like came in a Monday morning at 6 and hustled it out and figured out, okay, and said there's a real risk here, the market's missing. So we bought a ton of puts.
And again, you'd have viewed, hang on, COVID's coming in.
Yes. So that was about a month in when it kind of just left China and it started hitting Italy. And people were still like relaxed about it. And we just saw the exponential growth curve, and it was kind of a 3-hour debate in this boardroom where we realized that there's a chance here it goes way beyond what people think, because people underestimate exponential curves and how quickly they go out of control. So we bought a ton of puts there, and what those puts do is, if markets crash, they actually generate cash for you. Literally, they pay cash into your account daily as the market moves. So we end up there in the COVID crash sitting with kind of 40-50% cash in the funds because of the cash these puts are generated. Obviously that's the best time ever to have cash. When markets are weak and you're sitting on a ton of cash, you just deploy. And we were buying Visa, MasterCard, Google, Facebook, all the tech companies, because we thought they benefit from COVID. So that was very opportunistic and great, because it was at the right time when we could also deploy that cash at attractive valuations.
And importantly, again, like that is using what's available as a hedge fund, your tools available as a hedge fund.
Yes.
So again, that's also that kind of differentiator from hedge fund to your kind of your long only.
Correct. Yeah. And then also quite recently in end of December, end of Jan especially, we were sitting with probably 30-35% cash balances in the fund, just sitting there waiting to deploy.
Okay.
But wait, because we thought there was risk to markets, and then in Feb to middle March that played out. Global markets sold off 5 to 10%. SA markets came back a bit, and we probably put 10-15% of that cash to work at very attractive levels. So again, even a few months ago, we had high cash. So we're quite willing to, when markets are high, we see risks, sit in cash. We just know from 25 years doing this, the opportunities will come. You don't have to stress about sitting in cash. You're getting a nice yield actually right now, and then it gives you opportunity to invest when you see good ideas.
Okay. No. You mentioned again previously when we were chatting, I think last week, you mentioned like from a global perspective, you took high interest rates. We spoke about Visa and MasterCard. Can you also give us why you like those stocks from
Yes. Yeah. Sure. So Steve, one of the things we like to use the global universe for is taking advantage of opportunities you can't find in SA. So one of the themes we have is, because of the inflation point we made earlier, we think inflation will stay sticky. So how do you find companies that'll capture that inflation for you? And SA has some of them, but we don't think there's anything as good as Visa or MasterCard. Because if you think about it, they are a small percentage of every single credit or debit card transaction in the world. So literally
every time I tap,
every time you tap that, they capture their 0.1% of that. So basically, if some kind of store vendor somewhere in Vietnam pushes the price of his avos up 5 or 10%, the next time someone taps with a card at that store, Visa captures that inflation. The next time someone puts a price up at a hotel or anywhere else, they automatically capture that. So we think it's the best inflation capture business in the world. They don't actually have to put up their pricing. They get it automatically when anyone in the world puts up pricing, that they capture it. So we love those businesses. They actually came down a bit last year because of the higher long-term interest rates. So I think there was good entry points in them, and those are kind of nice core positions for us to have. They're not going to do 5 times your money, but they'll hopefully give you a nice 20% in dollars, capturing the inflation. And then there's this long-term shift from cash to card. It's still a tailwind globally. So we love those.
Very good. I think it might be a nice time to get to the questions. We've got quite a few. Am I right, Tarifa? Sometimes we don't get through all of them. So I do have a bit of a glare, but it's fine. So question 1 is from Sean. With a looming SA 2024 election, is this a risk you manage for? Your insights, please.
So look, it's certainly something we're keeping an eye on. I think it's too early right now. I mean, there's certainly some scenarios that could play out that, let's say, if we still have stage 6 load shedding the month before the election, then the ANC is going to get a proper hiding, right? So they have a real incentive to I think, figure this out before then.
Yeah.
So we're going to watch things, but again, we have the tools to put things in place for that, and I think we'll probably do that closer to the time when the opportunity is right. But I'll give you a very similar example. So in December, when this Pala report came out, and it looked for that one day that Cyril might have to go, right? It was again one of those.
I think the view was that he was going to resign.
Precisely, yes. So again, it was one of those. I think the report dropped the previous night. Like we all WhatsApped and we said, okay, let's come in early. We got to prepare for this before the market opens.
Yeah.
This is a material risk for our SA portfolio. So we came in before the market opened, figured out our view, and said there's a real risk, but obviously we're not sure it's going to happen. So is there a way we can protect? But you don't want to give up all your upside, but you want to protect if this happens. So again, we came in early. We got this when the market opened. We went out to all the banks and said, can we get put option protection on the rand? So we thought if Cyril goes, the rand would gap 5 or 10% higher, right? It'll go. I think it was maybe 17 at the time. We thought it probably goes to 19 or 20. So we literally got 1 week options, or I think it was 10-day options on the rand dollar, on like literally our entire SA book. So we said we're going to hedge our entire SA book with this, where if he goes out, SA shares will fall 10 or 15, but the rand probably goes. So for quite a small premium, because it was over a short period of time, and because we were in there early, we were probably one of the first people doing this, you could effectively protect that whole book. Now, again, clients don't see that because that didn't happen, and we actually paid a little bit of premium to do that, but that's kind of our job. We need to be taking the risk of those events out, because one of them will happen, and then we're going to have needed that protection.
An renegade type.
Yes, exactly. But you can rest assured our job is looking at these downside events and finding the best way to hedge the fund to make sure it doesn't have a meaningful impact on the portfolio if it does happen. So when the time comes, we'll be ready and look at that.
Cool. So the next question, actually, it's from Craig. I'm going to get to it, Craig. I'll get to it just now. So, then from Brian Dahl, how do you think the new reduction in oil production will affect inflation in the context of China ramping up development?
That certainly is it's a part of why we think inflation stays high. We think we think globally, if you look at most fossil fuels, oil, coal, gas, there's not massively excess supply, and it's only really oil where there is enough supply. But then the oil producers will not accept prices being too low. They'll just cut supply like they have done, because
as forever.
As they've done forever. That's why OPEC is a cartel in the old school way of being a cartel. So we think a lot of those oil prices have a floor, and that probably sets a floor on gas and coal as well, because it's substitutes in some way, and it means that we think inflation probably stays at 4 or 5%, because there's been structural underinvestment in especially things like natural gas in Europe, because they've lost the Russian supply. And then most of the commodity complex, we think there's been underinvestment over the last 5 or 7 years. So we think oil, all the commodities will probably put upward pressure on inflation, and that with the tight labor market means that we think it's sticky, and bond yields have to stay higher.
And just on that, I mean, do you think the Russian-Ukraine war is here to stay for a while?
Look, it's hard to say. My gut would be yes, because the thing is, Putin can't walk away with a defeat there, right? He can't, because he'd just be assassinated, or he'd be cut as president, which he doesn't want. So he would either want to win or just keep going for 5 years, because at least you didn't lose then, right? You just have a stalemate scenario. So it seems quite likely to me that both sides don't want to give him. Ukraine want all their land back, rightly so. Putin doesn't want to give it up. So I think we're probably in this stalemate for some time. But look, it's interesting how the world adjusts. We've adjusted to the sanctions on Russia. The oil is flowing again. So it's just amazing how even to these very extreme events, the world can adjust and go on. And right now, it's not really on the news because people have moved on. I mean, it's obviously sad.
Which is, I mean, it's amazing, that, isn't it? Like it's still, people are still dying. It's still war, and yet it's not as topical as it used to be. And it's quite sad. A question from James Gilfillan. Your view on Thungela right now?
Okay, thanks for putting me on the spot there, James. We think we like the results. Obviously, I think that the dividend was reasonable, and as we expected, that they did this Australian acquisition, so they probably could have paid a 65, 70 rand dividend, but they did this Australian acquisition, so you're only getting a 40 rand dividend out of it. We liked it, so I think we told our investors we sold out of everything kind of at about 320 to 380 average price last year. We've currently rebuilt the position there, not as big as we were last year, because we think this complete super profits for coal is over. I mean, coal's trading 150 today in Europe versus 400 at the peak, so that's a lot lower, but it's still, by historic standards, a good price, and Thungela will make good earnings of these levels. So we have been buying for the last month or so and rebuilding our position. And for the first time, I told the markets they've got one of the best potential gas fields in SA, which could be a small upside kicker. And we actually think this Australian deal they did is going to be a really, really good one. They have to prove it, but it looks to us running the numbers and talking to the team that I think it's going to add meaningfully. So we don't like it as much as last year at 100, but we like it again.
I think James is asking for a little punt for himself. So just also, I mean, again, just thinking about, again, you mentioned earlier about like some of the ESG stuff, the environmental stuff. I mean, so what view? I mean, I'm sure you got an ESG view or responsible investing view. I mean, like, and is it quite a big part of when you are choosing a stock or a share?
So I would say that of the ESG elements, we are probably most focused on the governance side, and that's where we make a difference. So we are very active shareholders in the companies. We invest. I think the management teams respect us. We always show up having done, hopefully, a lot of work, kind of give them good feedback on their businesses, and I think they respect the engagements with us. The issue with the E and the S is it's often a trade-off, right? If you kind of want to go, let's say immediately close all the coal plants in Europe, in the world, then, or the coal mines, then half the world won't have power, and there's like 100,000 jobs lost in SA, right? So this is not obvious to me that we want...
Your social issue.
Yes, precisely. It's not obvious to me that we want to lose 100,000 jobs in SA and want to lose 100 billion rand of forex revenue, or that we want Europe in the dark, right? So it's much harder there. So obviously in the long term, we think, yes, we must work to a greener future that's going to be good for all of us, but we think it must be managed and structured and done kind of appropriately within kind of the constraints we face. Like you can't close the coal mines while the power stations are still open. While people need the power, you need the coal. And last year, Thungela's coal kept the lights on in Europe. So I mean that's pretty important, right? Like we know in SA the cost of load shedding and not having power to an economy. So in the long run, we on that interest, but we don't think it's as simple as some people make it, where you can just be purely environmental or green focused without thinking about the other impacts.
I think also a lot of the time with the ESG or the responsible investing side of things is that is it a tick the box? And I'm not talking from a asset management point of view. I'm actually talking from a company point of view. Like they've got a team that does kind of that, but actually they just, from an accounting perspective, they're making sure they're ticking the right box.
Yes.
But I think that might, hopefully that's also moved on a bit now, and actually doing it properly.
I think it has.
Yeah. So just a couple more questions. I'm not going to ask question 5. I'm going to skip. I think we've covered that. Arifa. So then, how do you see the Tonga Hewlett fiasco playing out and the impact on the economy? This is from Anonymous.
So that's one kind of we've avoided over time, and we never particularly liked the assets, so we didn't have any exposure there. And where the situation is now, obviously, I think the banks will lose some money. Potentially, there might be some job losses, but I think typically what happens with these things is there is still some value in those assets. So it's mainly that the banks will have to lose money because there's too much debt versus the profitability of the current company. But in time, if you can properly produce on kind of the assets they have, that'll keep going in. So you'll either restructure and write down the debt and get the thing going again, or you'll sell it out of the business rescue proceedings. So I think we expect some losses on the bank's balance sheet, but they've actually already provided for most of that last year, and then it's just working through it and making sure the assets can produce and you don't have job losses around it. But we think it'll be solved. It's just the shareholders have lost their money. I don't think any of that's coming back. That ship has sailed.
Talking about banks, Silicon Bank, which went bust a few weeks ago. I mean, is that going to have this hasn't had a big impact on the banking sector like a Lehman's did.
Yes.
But I mean, what risk is there any risk in that left?
So the risk was over that weekend if they decided to not bail it out. If they let it fail,
which is what happened with Lehman's. They didn't bail out Lehman's.
Absolutely, that was and I think fortunately for us, policymakers have that pain of 2008 too fresh in their memories. Like, you probably need another generation to go by and the current people to leave office for new young people to come in and make that mistake again. But fortunately, most people don't want to go through the same pain twice. So thank goodness they bailed it out. If they didn't, I absolutely think we would have had a chain reaction. People have run from the other small banks in the US.
One thing I found fascinating about it is, and it's actually a really big bank.
Yes.
Yeah. So like I'd never heard of it before.
$200 billion of assets or something.
It's actually it's a huge business.
The interesting thing is talking about how good SA management teams are. I know the banks very well. The sector I've covered literally for my entire 16 years here. The mistake those guys made, it's just an absolute rookie banking 101 error. You've got notice deposits where clients can take in one day, and then at the low interest rates, they decided these clients that give us the money and can take it tomorrow, I'm going to put that in 9-year mortgage bonds, basically. So I'm going to lock that in for 9 years and lock in 1.5% on that. But you've got to pay that client whatever the prevailing interest rates is. So it just seems like an SA bank would never do that. It's just plainly insanity. You can take your money tomorrow, but I'm locking it in for 9 years. Like, it just makes no sense.
Surely the regulator should be managing a thing like that.
They should be, absolutely. They should be. So I don't know, like in SA, I mean, the SARB's actually really good. They'd pick this up at a bank, and you'd be forced to unwind it or not do it. But firstly, I think our management teams are just smart enough to not do it. It's just plainly stupid. Like, and it was just staggering to me. It's greed, because in that they just needed the patience to say, let's just wait for it. Rates will go up at some stage again, right? So obviously what killed them is they were paying the depositors 0, but they were also getting 0 at the Fed. So they said, how can we get 1% on our assets? Let's buy these 9-year bonds. But obviously it worked for 1 year, and then the next year it literally caused their business to fail. If they just had the patience to wait for a year, they would be earning 4% on that money.
Got a nice bonus last year, though.
Precisely. That's the issue. So it's greed and stupidity, unfortunately.
I'll ask 2 more questions from the audience, and then I've got a few more questions we're going to get to. And Dory Craig, I will get to your question. It's on my list as well. This is from Peter. What will the impact be of the BRICS countries moving away from the US dollar?
I think this is a key medium and long-term theme for us, is the power balance between the US and China. And effectively, all of us grew up in this 50-year era, or let's say this entire post-World War II era. The US was such a dominant economy that almost no one could challenge them, right? So it's actually easy. The US is the boss with any conflict. If they step in, their side normally kind of gets an outcome, and other countries are forced to listen to them. If they want to put sanctions on a country, the EU and the UK would follow. So it actually does provide some stability, having a clear dominant world power that can't be challenged. With the rapid continued growth in population and GDP in China, we're now getting to the edge where there's someone that can challenge them. And every year, if they keep growing at 5 or 6, they're getting closer to the US. So we are now entering a 5, 10, 20-year era where the US dominance is not that clear, and it will be disputed. And typically, if you look at history over the last 300 years, those are not stable periods where there's a new
Yeah.
power challenging the existing power. So I can't tell you exactly how it will play out because it's unknowable. It depends on various events. But what I can tell is we think this will be a meaningful driver of economies and markets, and it's something we're keeping a close eye on. I mean, there's nothing right now that we're doing for it, but I think it's one of our big overarching 10-year themes that we have to keep an eye on is that. And obviously, the clear thing is if a Taiwan happens, that's just Russia, Ukraine on a very different level if China goes for that.
And I suppose, like, I mean, at the moment, it's not like a big event. Am I right? It's kind of it's a gradual,
it's slowly building. And I mean, this BRICS going to the one or going to their own currency, that's another step in their process, taking power away from the power from the US, from the dominant player. So this is just it steps on that ladder, and often that ladder ends in conflict. So the question is, can we get through this transition without conflict at the end?
Exactly. So if there was a kind of invasion of Taiwan, that would be the event.
Precisely. But this all shows us the pressure is building. I mean, it's kind of building under the surface.
So it's a kind of a risk that you're watching and a theme you're watching.
Yes, absolutely.
Okay, cool. Cool. So just one more question from Deneen, and then we'll get to some more. We have got others. As your pure hedge fund is your low risk fund, would you use this fund to draw income from a monthly basis or not? So kind of more of an advisory question. I'm not sure if you got a view on that or not.
So I can tell you, like my dad retired about 18 months ago, so I'll tell you what we did for him. So he's got a living annuity where I think you can use hedge as much as you like. And again, he draws close, slightly above the minimum from that. And what kind of, so we built a portfolio for him was 20% in our high growth fund, which is his longer term where he wants capital growth and he doesn't really draw from that. 20% from the pure hedge fund and then 60% in the variety of other SA balanced equity low risk managers. And the pure hedge fund is the lowest risk fund we've got in there for him, and that's really to kind of to fund the drawing from because it's quite stable. I mean, even in COVID, I think in March when the market was down 15, pure hedge was up. So it is a good fund where it's unlikely you're going to draw down. You're going to draw when the fund's down 10 or 15 because we've never had a negative year. So that stability makes it a nice fund to draw from.
But you don't manage it to be like a living annuity drawdown fund.
No,
you manage it. Yeah,
we manage, but we do manage it with a goal. I mean, it's been 25 years. We've never had a negative year. So the goal is let's try to get double-digit returns while not having a negative year. We might have negative months or negative quarters, but we've never had a negative year. So we want to do low vol but low double-digit returns. And I think coincidentally that probably makes it a reasonable fund for that. But again,
it has those work. But again, I think it's very much an advice type of question.
Yes, exactly. So I don't want to go too close to it. I can tell you how we run it, but without giving investment advice here.
Hundreds. Okay, so I'm going to just get back to some of my questions, if that's right, and we will come back to quite a few questions still coming through. So my question, big one, I think I probably asked this in most of our webinars, was there a moment where you got a call horribly wrong?
Yes, this is always painful to talk about, but look, I think it's one of the things.
That's my favorite question.
It's one of the reasons why I actually like this industry is that it will never allow you to grow a big ego, because the moment you have an ego, the market will just teach you a lesson and completely smack you and destroy you, right? So I mean, the one that's just freshest on my mind, because I'm sure we've had many in the past, but it's just because it was very painful the last years, is Facebook, or it's now called Meta. It was a big position in our fund. We initially bought it at like $120. I spoke a lot to clients about that. We were out there that we liked this. It ran all the way up to 380, so it was fantastic. It was 3 times money over 4 or 5 years, and then from September 2021 to like end of last year, it went from $380 to $90. I mean, it's like 75% down. And it wasn't a small holding, it was one of our biggest holdings in the fund. So it was a very, very costly mistake. And I think, look, it's frustrating we made it, because normally our process, I think one of the things that differentiates us is most people will hide their mistakes. It's awkward to talk about mistakes. It might affect your bonus, or you might get fired. If you're at a big long only, it's more bureaucratic. So you kind of just want to keep the mistakes to the side, where we're like, let's go to our mistakes. If there's any issue at a company and we start losing money, let's go at it and let's look at it and see what the issue is. And we're happy to cut it and make the money back somewhere else. You don't have to make it back. And so typically we catch these losers early and we limit them. But in this case, we didn't. And if I look back, there was 2 big things that happened. Probably the biggest one was Apple, that changed their ability to target on the iPhone. So many of you might have Instagram or Facebook. They now have to ask you, do you want to allow this app to track you on your phone?
Yes. Was that a legislative thing, or was it Apple doing?
This is purely Apple doing this. And
From a privacy perspective.
they say it's for privacy,
Yeah.
okay? But the real reason is they are massively growing their own advertising revenue. You'll see
Yep.
there's ads on like the settings page, there's ads in the App Store. So they're very good with branding, Apple. They say
Yeah.
it's for you that we're doing it's for privacy. And I mean, there is some of that. But largely, if you look at how fast their own advertising business is growing,
Yeah.
and they're tracking you without asking you because it's their phone. So it's really unfair, and they're abusing their monopoly power. But that's reality of life. I can't complain about that. I still lost money for my clients, so we don't blame other people. We made the call, and we historically, like the EU did that as well. But the EU one, like you could ask multiple times for the client if you could track him, and eventually, once you got to yes. Where Apple says you can ask once, and if he says no, you're not allowed to ask the person again. And way more people opted out than I think the company thought and what we thought. And that had a big impact on their targeting and a big impact on their revenue. And then also at the same time, TikTok came up and started taking a lot of market share from the young audience. And what happened is this obviously impacted Facebook's revenue, but at the same time, they were still hiring a lot of staff because they were in this COVID mentality where the business was doing well, so they were hiring, so their cost was growing while the revenue was declining, and obviously that squeezes your profit massively, and that caused the share to decline. So, look, unfortunately, there's it's got not a complete happy ending. I mean, we've still lost money, but I mean, it bottomed at 90. It's like back at 200 now.
And you still hold?
Yeah. So fortunately, we didn't sell. I wish we had the guts to buy 3 times more at $90, but I mean, at that stage, it's already a tough call to hold on because things are looking bleak. But we certainly had those debates on what to do, and we decided let's just hold it. And obviously, what's happened is the company said our revenue is rebased, but let's rebase our cost base. And I mean, Zuckerberg's taken 25% of the staff out of the business without impacting things. So that's got it back to $200 a share. So it's much less bad now than it was 3 or 6 months ago, but it's still an extremely painful one. And I think there's good lessons to be learned there for us.
Because you'll see here that Apple's actually now like an old man's social media network now.
Facebook,
sorry.
Yes.
Facebook's like an old man. Like,
yes.
So actually, the youngsters aren't on Facebook.
Yeah.
I mean,
Instagram and then TikTok.
Yeah.
So one of the things for the re-rating and what we hope is that the US will ban TikTok. I mean, we think it probably should be banned.
Really?
Yeah. So it looks like it's.
I mean, I've seen this the clips in the news and that and the inquiry. Yeah.
So look, firstly, I think just linked to this previous question on the long-term power struggle from China and the US. These are guys are going to challenge you for world power. It's insane to have their potential spyware on every single phone in your country. It just seems like a stupid thing. And they ban all your apps. So why you let them ban all your apps, but you don't ban theirs? It just tit for tat, just ban theirs as well, right? And like almost more on a personal level, I don't think it's good for people's mental space and mental development that you're sitting on TikTok all day. I think it's extremely addictive. It's almost like a mind hack. They figured out how to just mindlessly lock you into watching on this phone. But personally, I'm going to keep my own kids away from this as long as I can. I just don't think it's a net positive for society. But that's not obviously people go with what they enjoy, and kids love kids love watching those videos.
Yeah, it's going to be fascinating to see it all play out. So just a couple of one thing. So again, almost bringing it back to just to kind of hedge fund perspective. And so, question we spoke about earlier is that one of my favorite movies is The Big Short. Okay, and I'm sure we've all watched it, about the global financial crisis back in 2008. And Christian Bale plays a character called Michael Burry.
Yes.
That's right, and he is a hedge fund manager, and he features quite a bit. But the scene that sticks in my mind is his clients phoning him and wanting their capital out because he's actually been losing money. And he says, no, you can't have your capital. So literally saying, sorry, you can't take your hard-earned cash out of my fund. I'm basically saying it's almost, I don't say it's capped, but it's closed for that. Now, and obviously in the long run, he gets it all right, and actually his clients do incredibly well.
Yes.
But the question is that can you envisage a scenario in SA where clients phone you and say, I want my money out, and you say no?
So no. So firstly, I mean, I'll comment on Michael Burry now because he's a bit of this mythical legend in the hedge fund space, and there's quite a following.
Also make him
precisely, and the movie makes him larger in life. And I think early on in my career, I read those books. I loved it. I loved the story around it. But on this specific question, no, we are under the Collective Investment Scheme Act. Our funds either have monthly or daily liquidity. We've been running them for 25 years. We've just the moment you ask, you get your money. As I said earlier, at times we run 40% cash, at times we run 20% cash. We've got a ton of cash, and we've got JSE listed shares. You can liquidate them in a few days. So we've never had a situation like that. I can't foresee a situation where that ever happens. So no, I don't. The SA regulations are different. It's like if you can pay the client, you pay the client. You don't have that option to say you're not allowed to take your money now. Clients can get their money. But on this case specifically, it goes to an interesting point where I think I might have touched on it earlier, where if everyone hates a trade, then it's often might be a good trade. So in this case, he was short the subprime bubble, and he was like 18 months early. He could see this thing bursting, but you never know exactly when something will happen. So he started putting this trade on. And obviously his clients then lost money for those 18 months because he was a little bit early and the bank's screwing him a bit.
The scene is actually an empty office.
Yes.
He's got a full office at the beginning and then they got an empty office. It's just him writing on the whiteboard.
Yeah, precisely. And I think he tells his clients, this thing's about to pop, like we can see it from the data, just hold on. And the clients, they obviously don't have the detail of the trade, they don't have the patience, and they just want their money out. And I think at the end markets were down 50% in 2008, and I think he made like 200%. So it was like almost the best fund in the world in that year. So it's hard to say, was it the right call? I think if clients want their money, they should get their money. But there certainly was a case to say, he's like, just give me like 12 months and you're going to just do so well. And it ended up working well for the people that kept their money there.
I think also a big difference there also is that he was like with a kind of a boutique institutional type hedge fund. Am I right? And it wasn't actually a retail. There were only retail clients invested in his fund. I don't think. I think that, which is again in the CIS world, you are actually the way you structured is for a retail client.
Yes. Yeah. But sometimes as a manager, the good opportunities are there in instruments where your clients are going to shout at you when you buy them. So let's say, I've told this story to some of our clients, but like we were, like when African Bank failed back in 2014, so we were short the share, we made some money on the short, but we actually made much more money after the failure. African Bank had sold bonds to like Swiss pension funds and Swiss private clients. So obviously you sell the bond because you lend out the money as a micro loan. And obviously once they went to curatorship, these kind of Swiss and US investors, they just like, I've got this micro lender in Africa that's not repaying me, I just got to get out. So we bought a ton of those bonds at 60 cents in the rand, ended up getting all the money with very attractive interest back. It was kind of one of, if I look at absolute percentage profit, it's one of our greatest trades ever. I'm sure if we don't always talk about our positions for this reason, but if I told my clients I put 10% of the fund in African Bank bonds, most of them would have shouted at me and not like me, right? But it was the best thing to do. So often the contrarian thing that people think is crazy or strange at the time is the right thing. So you must be willing to, like, I think if you want to make money through the cycle, be willing to swim upstream at times.
But I think it's such an important point again, is it? So what again is it? The reality is you don't want 100% of the client's money. You want a portion of the money. So if guys have got appetite for saying alternative, this is and this is kind of a place to look at. Am I right?
Yes, and that's such a good point. I don't think for any clients except myself we're 100% of your portfolio. I think for me and Dave, you are. We don't we just say we got to eat your own cooking. I'm not going to invest with any other manager. But that's right. You're in a portfolio, and to deliver uncorrelated returns with downside protection, you have to look at places where others aren't. That's kind of our job. So I'm going to find some off-piste investments that you haven't seen in other funds, but that's, I think, what makes us different. And for that reason, have us at a manageable size in your portfolio where we can protect the downside and deliver hopefully some upside returns for you.
So I want to actually get to Craig's question now. So we've got 7 minutes left. So so this is about fees. So I had a question on fees as well. So, and again, I think is topical. Okay, so Craig's asking, I struggle to invest in funds with uncapped performance fees, especially when the benchmark is zero. Any comment on the fee structure and the retail hedge funds? Changed my mind on this view. It's very well put, actually, Craig. I like that.
And I'm
better than I'd put it, I must be honest.
I'm happy to answer that. So if I start with what's the North Star of our business, what's our mission? Creating wealth for clients on an after-fee performance basis. So I've got to deliver the best after-fee returns I can for clients. And I'll go into how we do that. So firstly, our base fee, if I take pure hedge, our base fee is 1%. That's effectively the same as most stable funds. That's competitive. And then in pure hedge, we charge 20% performance above a cash hurdle. So we got to do cash first, and then in pure hedge, we get 20% of the returns after that. So if we do 15%, for example, that's, let's say, 7-8% above cash, and maybe there's another 1.5 performance fee. So we only earn fees when the client does well, and the client sees, and we only show you the net return. So our fees will be high when the performance is higher.
So just make again, so you're saying that your performance fees only kick in once you've reached that hurdle rate, essentially.
Yes, for the pure hedge fund. For the high growth fund doesn't have a hurdle, so that's because it's less cash based and more market based. The pure hedge fund has a hurdle. The other key reason for the fee structure is almost a business reason. I think you're going to have much better returns over time if you run a much smaller asset size business. So we're like 15 billion large managers, 100, 200, 500 billion. So, and the size of money we will and can manage is capped. We are not asset gatherers. We're going to close the fund again at some stage. We have been closed for probably 5-6 years out of our 25 years when we hit capacity at that time.
Okay.
So we've taken the choice to say we think clients are going to be better off investing in a smaller fund where we're very flexible. We can move in and out. We can make good money off mid caps. But the trade-off for me is I've got to hire the best talent in the SA asset management industry, or what we think is the best talent, off a smaller asset base. So for that reason, our fees just has to be higher. Like there is no scenario where I can charge index fund fees on a small asset base and get the best team in SA. And I think what I just so the reality is to run that model, your fees has to be above industry average because we want to have very high talent density in our business, but on a smaller asset base. So you get that amazing skills that apply to a small amount of money, and that's driven our outperformance over time.
But again, then it also goes back to that. It's like from an advisor or client, don't put all your eggs in one basket. It goes to diversification play. Put a small chunk or a chunk into your overall client portfolio, and then actually the large fee maybe isn't so bad.
And I can tell you, like I don't think I've had a single client with us for more than 3 or 5 years that's ever worried about fees. Because in the reality, what you eat and what you see and what you get is the net returns after fees, and that's where we've done 100x since inception. So I think, I mean, there is trade-offs. Some people choose to invest in index funds, but then you can't beat the market, right? Then you're guaranteed to market minus 40 basis points or whatever your fee is, where I think we've handsomely beaten that after fees, even with our high fees. So life's about trade-off, and we think we're going to do better for client net return with the model we've chosen.
No, cool. I know we've only got 4 minutes left, so we'll try and get through 1 or 2 questions. From Russell, do you guys have an idea on your capped AUM amount for your funds?
So I can't put a specific number on this because the way we do it is we consistently track, let's say on a monthly or quarterly basis. When you want to trade in and out of shares, how are we finding the liquidity to get in and out of versus the liquidity and trading volume in the market? Unfortunately, over let's say the 15 years or 16 years that I've been here, JSE liquidity has picked up over time, so that's meant we can handle somewhat more assets. And we also invest somewhat more offshore in Visa, MasterCard, we talked on earlier, Google, Microsoft, those are infinitely liquid. There we can do as much as we want. So let's say some portion of our assets are there, which has taken some liquidity strain off, and with an increase in liquidity in the JSE, we are fine where we're sitting right now, but as I said, it won't be infinite. I don't think it's much more than double the current asset base. Potentially, it might kick in even earlier than that. What might change is if we find more offshore opportunities and allocate more, maybe that changes because that obviously adds liquidity. But it's I'm going to tell you now, it's not 100 billion, it's not 50 billion that we can handle.
And actually, so also I suppose like something you'll be watching in terms of what is available, and you're starting a sense that, hang on, maybe we're getting close to that point.
Yes, so that's in the past how we've closed. We just, I mean, it's more of a feel than a number thing. I can't run a spreadsheet, but it's just like we can't kind of execute what we want here, and we're not close to that right now. But historically, when we've had that, I think it was 2007 we were closed, and then kind of 2013 to 16, 17 we were closed because we just felt, given the liquidity at the time and how we were focused on SA, that it was the right thing to do. So it's going to be when we see the market tell us that we'll have to act.
Cool. I think we've got time for one more quickly. From David, do you have a view on the rise of India, the largest population in the world? I don't think it's the largest population, is it? I think China's still the largest. I'm not sure.
Yes. So I mean, I think the Indian markets has done fairly well, but our view is we've got to play where we have edge. And I have real edge in SA because our team's here, we know the companies, we're on the ground, we know people in the companies, we know the market structures. Unfortunately, we don't think we have a competitive advantage there. So I think that economy will grow. I think it's going to be a very significant, meaningful part of the world right now, but we haven't got any, let's say, in investments in India. And at this stage, given that we come from an emerging market, like if I want to diversify my portfolio for clients, we're rather going to go to developed markets, right, and buy developed businesses rather than buy more EM when our clients already have a lot of EM in there. So our incremental time goes to kind of Europe, Scandinavia, the US, finding opportunities there rather than India. But obviously, I think India will continue to grow.
Okay, cool. So we're pretty much out of time, and that ends it. I mean, so first of all, So Jacques, thank you very much for the conversation. Really
Thanks,
do
Steve.
appreciate
Enjoyed
it.
it, eh?
No, it's been good. Thanks to the audience. I mean, as always, we do appreciate your time. And the questions I think were great, and they came through thick and fast. And apologies for the ones we didn't get to. Just checking my notes now, just in terms of from a close perspective. CPD points we spoke about. So we should get one for this. Again, just look out for the kind of the thank you mailer. It'll be in there. And I said, if you came in late, then you'll just might have to do a short assessment, but don't worry too much about that. Also, just from obviously we got quite a few webinars and functions coming up from an Innate perspective. Please follow us on LinkedIn, and you'll see all the bits and pieces and all the webinars and podcasts, etc. on LinkedIn. And I think that's about it. Thanks again, Jacques. Thanks for having us.
Steve,
Been
eh?
good.
Thanks for having me.
Appreciate it. Thanks.
Innate is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.